that's good coffee. When you spend enough time in the markets, you figure out pretty quickly that the price does whatever it wants to do. And one thing I noticed is that price very rarely reacts to specific Fibonacci levels. Like, people expect retracements and then immediate reversals at the 50% level, or the 61.8, or the golden zone, or whatever people are calling it these days. It's usually close but not exact, or it's extremely off. As I continue to collect data over time and keep studying market behavior, I started noticing that price rarely, if ever, respected Fibonacci levels. I noticed patterns for certain pairs. And I just want everybody to understand that Fibonacci is just one of the many confluences I use before entry. It's more so just a box that's checked. After enough data collection, I've been able to identify what I would consider zones of tolerance, or tolerance areas, or acceptable ranges after Fibonacci hit a certain price, and that allowed me to stop obsessing over pinpoint accuracy on the Fibonacci, because again, the market does not reverse at the 61.8 every single time. So you'll be missing out on huge moves for this one confluence alone. Now, before we go any further, let me explain to you what you're looking at. The numbers on the left represent the size of the structure that I'm measuring. The numbers on the right represent the tolerance I allow around the midpoint of that structure. Tolerance is simply the amount of room I allow around like a certain level before I start actually paying attention. Now, naturally, larger structures get more room and smaller structures get less. I mean, obviously. For example, let's go ahead and use GBP USD. Let's say there's a range of 150 pips. The max range tolerance on 100 is 3, and then the max range tolerance for 50 is 1. So you add those two together, 150, the max tolerance is 3 plus 1. That's a total of 4 pips, or 40 ticks on TradingView. Is essentially the same thing. Now, 4 pips may not seem like much, but testing this showed that it was often enough for the retracement to actually qualify. And anything from that point on down is fair game for me. Now I'm just waiting for price to react, not specifically waiting for it to reach a certain level. So essentially, these are not prediction levels. They're simply the areas where I began looking for the rest of my setup. And remember, I said that Fibonacci is just a box that is checked. It doesn't determine whether I get in and out of trades. It's nothing like that. It just validates my reason to say, okay, this has retraced enough for me to stay on this time frame and then get ready to execute. And you'll also notice that there are only 3 instruments on this table. It used to be 4. I actually got rid of one. USD JPY was originally part of the study, but eventually I removed it because, well, if you follow me on Instagram, all I took most of the time before I came to this realization was USD JPY, because it was extremely momentous based on how I trade Fibonacci. So one of the reasons why I picked up US30 was because it displayed far more consistency than USD JPY, believe it or not, through the exact same framework. All right, so now let's take a look at how I apply this on the charts. Let's use this. All right, we got ourselves a pivot. Oop. All right. Oh, let me kind of clean this up so it doesn't confuse anybody. Smooth that out the way. All right. So if we grab our Fibonacci tool, and obviously we have the common settings that we see, the 38.2, the 50, 61.8, etc. All right. So what I would do was, in my study, I would grab the measuring tool, from the lowest point to the new high of the structure that just got created after the break. And roughly we see a range value of 231. So if you refer back to the chart, that's roughly around 5 to 6 pips. So let's use 6 pips. So I don't know if you can see this, but the midpoint obviously is the 50% fib level. So that would be 31535. So if you add 6 ticks, naturally that's going to be 31595. So let me just write that down. All right. So that would be my range tolerance. And if I switch this to what I usually use for GU and XU, it's probably going to be right spot on. Exactly. So literally from this point on down is free game. Now let's do it to the next structure, or apply it to the next structure rather. Same thing. And I believe this is roughly around 40%. Let me see. Or 47%. Yeah, 47. Just add that on there for everybody. All right, you get the idea. So literally from this point, if price comes up here and does not touch, it's not fair game. I'm not interested. From here all the way down, fair game. It touched it, I'm looking for longs on the same time frame. From this point on down, everything is fair game. Now again, I'm not just hopping in the trade just because price decided to touch this area. This is just telling me, hey, it might be a good idea to stay on this time frame and start looking for executions. Now there are going to be a few times, like you just saw earlier down here, if price does not touch this zone, how do you get involved? That's when you scale in. Literally, once I see another pivot, I'll go to a lower time frame that's equivalent with scaling in for the 4 hour, which naturally be for me on the 15 minute, and then I'll start looking for longs that way. Now, just to make you guys aware, I'm not sitting up here doing math problems, calculating max tolerance levels for every single range or structure that occurs. Absolutely not. This is just the story of my back testing and what I landed with of what areas I saw price react to the most. Now, naturally, on other pairs, like I mentioned earlier, there might be different range tolerances. For example, I know for a fact that US 30 is much higher. It's at 40%. And I'll actually show you a couple examples of me taking a trade on gold. And the last trade breakdown I used with US 30 was a perfect example. All right, so I'm gonna grab a gold example. All right, perfect. All right, so if we start from this point right here, like pretend like this didn't happen yet. So from this point, price continues to go down. It's bearish. It closes below. So now we have a new lower low made. And then once the body of price gets violated from the previous bearish candle in this example, because it's bearish, that's what this purple line is. This is my pullback line. From this point, the highest point to the new lowest point is where I apply the fib tool. And again, for the record, GU has the exact same 47% fib level that I'm looking for that also applied to GU. So GU and gold, I use 47% again. So price has now returned back to the range tolerance level. Now again, remember, I'm not using the fib as my only confluence. This is just saying, hey, you might want to pay attention, stay on the same time frame. So for example, if price does not hit my range tolerance level, but it hits a support and resistance level, that's another confluence. I'm not using one, I'm using multiple. So once price got to here, this is when I said, hey, let me switch, because I don't enter on Fibonacci. Remember, when I'm getting ready to enter, I just essentially switch from Fibonacci to regular candles. Let me see if I'll pull that up for you. All right, perfect. Now I'm considering what price is doing because I'm getting ready for entry. Like, this is perfect. Like, the last two bullish candles, you got a nice bearish pin bar or a hammer, and then when this bearish candle closed below the entire thing, we got our evening star. That is a bearish variation. So not only do we have contact with the 47% retracement, we got a strong bounce from the EMA, our RSI is below 50. Like, I'm ready to pull the trigger. And that's exactly what happened. As soon as I did that, price fell out of the sky. All right, let me show you the next example. All right, so this is the US 30 example. All right, as you can see down here, we got a structure break or a pivot, and we got a bullish impulse, and then this little line. Let me see if I can zoom in here. All right, this little line, once price closes on the opposite end of this here, that would be our valid pullback. So that's when I take my Fibonacci from the lowest point to the highest point. Now again, my range tolerance for US 30, if you can see right here, that says 40%. Again, like I mentioned earlier, it's significantly higher. So once price taps into this level, taps a support and resistance level, and now we have a strong bounce on the EMA, I'm ready to get busy. So let me go down to the regular candles, and literally right here is where I entered. From the last bearish candle, we got a huge bearish engulfing. I'm sorry, a bullish engulfing with a nice long wick. That shows huge pressure and momentum. So that's when I pulled the trigger and price literally took off. All right, everybody. At the end of the day, this is simply what's worked for me. I'm not telling you to use these exact numbers, and I'm not saying that this is the only way to use Fibonacci. What I'm saying is that this is the observations that I discovered simply through collecting data. So if there's one thing I will encourage you to do, is to spend time collecting your own data and testing your own ideas. The market is always changing, and the best confidence comes from seeing something for yourself rather than just talking to somebody else and taking their word for it. So as always, thanks for watching. I'll see you on the next video. I'm out.